Okay. What is the FICO score? It's basically a summary of what's in a consumer's credit file. So it is a mathematical algorithm that takes a look at the data, certain types of data that's in a consumer's credit file, and then assigns a numerical value to that. The higher the number, the lower the risk for a lender to lend that consumer money. So in some ways, we are the original big data company when you think about the amount of data that the score looks at in order to come up with that number. A quick little timeline here, key milestones of the score, as I said, created in 1989, different specialized versions of the score for the auto industry, mortgage industry, and credit card industries were rolled out in 1993. It became the standard for mortgage underwriting by Freddie and Fannie in 1995, and we launched a consumer website in 2001, myfico.com, to start to help educate consumers about what goes into the FICO score, how they can manage their score, how they can improve their score, to sort of, again, take away the mystery behind the score and help them understand it more. Began to go international in 2004, so it is not just the U.S. score, it is now in certain countries. Most recently, we've been working with the People's Republic of China, their national banking institution, to set up a scoring system in China, and so that they will be rolling that out sometime in 2015, so that the Chinese will now have FICO scores, not FICO scores, they won't be called FICO scores, but credit scores that lenders will be able to use to start to roll out credit there. We've done the same thing in Russia, and so the Russian economy is now sort of looking at scoring, credit scoring, that kind of thing. We just last week announced the next version of the score, FICO Score 9. Got a lot of great coverage around that, considering that we've made some changes into how the score is treating, in particular, medical debt collections and collections in general. So just, we've been at this for a while, 100 billion scores sold, 10 billion scores sold each year. The score is used in 90% of lending decisions in the U.S., so it is the credit score that lenders are using to make lending decisions. We differentiate between the FICO score and a lot of what we call educational scores that are out there in the marketplace that you will see marketed through the credit bureau sites or through websites like Credit Karma and, Credit Sesame and those kinds of things. Those are not FICO scores. They're valid scores, but they're ultimately not the score that a lender is using to make a lending decision. So that's the key distinction between. And what the FICO score does, it does help lenders make those decisions across a variety of industries, as I mentioned, but also a variety of points. So the score is used to market to potential new customers. That's how you get those credit card offers in the mail or online, as well as to manage an existing account. So that's how lenders make a decision about whether to increase your credit line, change your interest rates. They're pulling those scores, your FICO scores, on a regular basis to take a look at, if your credit rating is improving or worsening, and then making decisions on how to manage your account based on that. We work with the 3 credit bureaus here in the U.S. as well as credit bureaus in Canada. And so the way the process works, which I think a lot of people aren't exactly aware of, is what we make is a mathematical algorithm that we then license to the credit bureaus, Experian, Equifax, and TransUnion. They use that algorithm to run against their data to create the 3-digit score, and then they sell the score to lenders. So where we make our model is we make the money off of licensing the score to the bureaus, and so that's how that works. And so this is sort of kind of a look at how the ecosystem works. We work with the lenders directly in terms of understanding their needs and what they're looking for from the score and what changes are happening in the consumer credit marketplace, how people are behaving. Consumers are getting the score either from the bureaus or from MyFICO directly, and then we're working with the bureau, so, sort of crisscrossing back and forth all the way. And MyFICO is in the middle. So MyFICO is our consumer site where we also sell products, but we also created another site called scoreinfo.org, which is where we make free information, educational information with no marketing, no sales, anything, so people can just go and learn about the score at that site and not sort of have to deal with any sort of sales things. And then we also launched a program late last year with several lenders called FICO Score Open Access, where we're working with them to make the score available to their customers for free. And so one of the biggest ones that has signed up is Discover, the Discover card. And perhaps you've seen they've been doing a lot of television advertising about the free FICO score being available to their customers on their website and on their personal statements. And so they've seen, making that score and information about the score to help consumers a benefit for them and a differentiator for them against other credit card companies, and so they've been super successful with that in terms of securing new accounts via that. We're in negotiations with a lot of other major banks and credit card companies to make the score available through this program for free. The idea being, to get the score in front of as many people as possible, because from a business perspective, we have future products that'll be coming out sort of built on the score. So the revenue that we get from selling the score is going to diminish as the score becomes more readily available for free. But we've got other products in the pipeline that are built on the score in terms of ID theft and other monitoring products that people will be looking at and will be marketing going forward. What goes into the score? What is it about your behavior that drives the score up or down? It's actually really pretty simple. These are the 5 things that if you do these things correctly, your score will go up. Number 1 is paying your bills on time. Paying your bills on time, every time, period, end of sentence, full stop. That's the most important thing you can do. Number 2, and it sounds simple, but people are like, oh, but I skipped 1 month. Is that bad? Yeah, it is actually. I'm sorry. I'd like to tell you it isn't, but no, it is. And number 2 is managing your debt. So particularly around credit cards. So, the better score is going to be driven by keeping the debt you're using at about 30% of the credit you have available. So 30% is good, 20% is better, 10% is awesome. I think it's a little unrealistic, but at least, it's out there. So the idea of keeping your revolving debt down and manageable, though, so that's 30% of the score. So that's another key piece. The third piece we tell people is only open new credit when you need it. So when you're standing in Banana Republic or Talbert's and the clerk is offering you that free credit card, 0% financing, don't do it. If you don't need it, research shows that the majority of the people that say, oh, I'm going to pay this off and close the account, yeah, that doesn't happen. And those cards typically have higher interest rates, so it's just a bad move all the way around. The mix of credit is important, but it's not critical. And also the length of your credit history. So those, again, super simple, super straightforward. This is a distribution of what the score looks like over the last, since 2005. And what you see is that despite the economy downturn and stuff like that, the distribution is pretty consistent. So what that says is that the score is consistent and adapts to changes in people's economic behavior and what's going on in the economy. So it doesn't become irrelevant over time. It stays relevant. And we look at, working on the data and looking at the most recent data. The score that's coming out next, FICO 9, is based on data from within the last 2 years. So it's super, super relevant. Just a quick thing about who doesn't have a FICO score, the quote-unquote unscorable. And it's basically the things that the score looks at in a credit history are that you're not deceased, you're not dead. Sounds obvious, but you need to not be dead, that you've had one account that's been open for at least 6 months, and that you have one account that's not in dispute that has been used within the last 6 months. It can be the same account as the one that's open for 6 months, so you don't have to have a lot, but you do have to. One of the things we are looking at in terms of how do you score those people who don't currently have a traditional score. You read a lot about how millennials are shying away from credit. They're going to debit cards and a cash-based lifestyle. We're doing research now around other kinds of data that's readily available that could be valid. You hear or you read a lot about people thinking about social media data. That's not valid, but what we are looking at, utility bill payment information, property records, and those are looking like they are predictive of someone's likelihood to repay a debt. Again, just to differentiate between the FICO score and educational scores, FICO score is the one that lenders are using. Educational scores are just that, informational, directional, but they're not the score that's relevant in terms of what a lender is using to make a decision. To the point of what makes a good credit score, why isn't, for example, social media data that should be looked at in terms of giving someone credit. The key things are the breadth of the data. So the FICO score is touching almost every American that is using credit in some way, shape, or form. It's important to meet the government regulations that are out there to protect people. And it's also important that the data be accessible and reviewable and correctable, so that if you do find something in your score, in your history that isn't correct, there's a mechanism for you to get that fixed. And so those are the key points. The banking system, the credit system is based on the FICO score and is built into the FICO score. We work on making the score transparent, so it's not a mystery what goes into the score, so that people can know what they need to do to improve their score. And it provides an unbiased opportunity for people to access credit. The score does not look at your race, your gender, your salary, your savings, things like that. It really is looking at your past performance with credit as a predictor of your future performance with credit and repaying a debt. And there you go. Yeah, absolutely. Yes.
Did you want to take the mic?
Individual counseling session for anybody who's interested with Anthony. It's $20 and yeah.
So I mentioned it a little bit when we were sitting over here. Obviously, we have quite a few unbanked. I work with Small Monica, and the majority of our customers are unbanked. However, we also look at what we can do in order to increase smart usage in a lot of this country. Subsidizing phones without having, a banked history and a thick file is something that's really difficult. We've been leveraging our local usage data to see whether or not we can prevent it seems to be working. I'm actually interested in how FICO looks at the unbanked in the United States.
Right.
And if there's different type of scoring, different type of data that you're looking at the unbanked.
So, yeah, to that point, so figuring out how to appropriately make credit products available to the unbanked, people who are outside of the traditional banking system that most of us know and operate in, is a big thing for FICO and a big thing for the banking industry in the United States. But it's tempered with also the desire to make sure you're making credit available to people who really are ready to take it on. Because it doesn't do anyone any good to offer credit to someone that's not at a place to manage it appropriately. It hurts them, it hurts the economy, it hurts the lender. So it's how do you do that prudently? And looking at what we call alternative data, and what we mean by alternative data is data that's not traditionally found in a credit history, things like utility bill payment, because that is a type of financial obligation, and someone meeting that financial obligation every month, paying their utility bill every month, is an indicator of their responsibility financially and their likelihood to be able to repay a debt. So in terms of, looking at not necessarily mobile phone usage, but mobile phone, paying your mobile bill on time, paying your rental bill on time, looking at other types of financial obligations that you have that aren't typically reported, but that there's a database where you can access that information, and sort of looking at that and sort of, so that kind of thing. So we did a big research project for a major bank last year looking at this, because they wanted to figure out what types of data are the most valid to be looking at. And the things that did came up are property records, rental records, utility bill payments. And so we're about to launch a pilot project with some data providers here in the US that have databases of that kind of information, that have the breadth that's necessary. Because one of the issues is you want to cover a significant portion of the population to be able to evaluate this data, and you want the data to be reachable by those consumers to be able to correct any misinformation. So those criteria are really critical in order to decide what type of data. So we've got some stuff in the works, and hopefully we'll be making some announcements around that later this year. But that's the kind of stuff that we're looking at. And again, when you read about startups that are doing stuff based on social media, and our concern with that is, as we all know, it's very easy to sort of inflate or distort your perception on social media without anybody monitoring that. And there's no ability to verify it. There are limited abilities to correct it, if there's misinformation about you out there. And so that whole category of social media is not something that we're looking at right now.
Really quick.
Sure.
When you look at that data, though, we wouldn't be comparing apples to apples, so you wouldn't get FICO score, you get net new score.
Well, that's what we're trying to figure out. If it's a net new score, or if it's an adjunct or a version of the FICO score. I mean, there's the ability to look at that data by itself. So you create a new score just based on that data. And there's the ability to look at that data in the case of someone that has what we call a thin file, which means they have a very limited credit history. And so you could marry the two in that situation. FICO Lite. Okay. Thank you. Oh, one more. Oh, yes.
So it seems kind of independent of a person's ability to pay a particular amount. I may have a high FICO score, but my ability to pay a $10,000 debt is different from a $1 million debt. So how is that factored into the bank's calculation of the likelihood of paying?
So while the FICO score is used in 90% of those lending decisions, it's also important, it is not the only factor a lender looks at. So the information you provide on an application, such as your salary, job history, et cetera, the lender is looking at that information in addition to the FICO score. And so that's when that stuff is sort of factored in by the lender. The FICO score really is meant to look at your history managing debt as a predictor of your future likelihood to manage debt. And so that's why the factors that it looks at are very much credit related and debt related. The lender looks at other stuff to make a decision, but that's a key part of it. If you've managed your debt successfully in the past, our research shows after 25 years, that's a good indicator that you're going to do fine going forward.
So I guess each lender has its own model.
Right.
Countrywide,
Absolutely. And they made huge changes in their lending practices based on products they were offering that looked at factors outside of the FICO score to make those decisions. The algorithmic work, wow, that's a good one in the morning, is really dictated by the data that's available. And so the algorithm will be developed to sort of really optimize the data that's available in that particular market. The way the score is used is typically the same. Like, for example, one of the first countries we went into was South Africa, and the factors of the economy and what was going on there were very similar to the U.S. And so the way the score was implemented into the banking and lending system there was very, very similar. In countries like China and Russia, you're looking at a very different marketplace because there was not a lot of credit history, there was not a lot of data. So in China particularly, it's basically consulting with the government there to figure out what are the things you have, what are the necessary components of the eco structure you have to put in place before you can even build a score. So how do you begin to gather that data? What's the data you need to gather so that you have, the data that a score can look at in order to develop a score? So it's very different. Whereas in places like South Africa and Turkey, for example, the data already existed. It was already being gathered, and lenders were looking at it, but they weren't evaluating it mathematically with the algorithm. So it wasn't as efficient. What the algorithm allows you to do is to analyze that data very quickly to be able to spit out that number and make a decision.
Is everything data driven, or is there some kind of subjective, like this person say, oh, you look nice, so I'll give you a question?
In terms of the score, it is absolutely all data driven. And so that's why subjective things like salary, like gender, like age are not factored into it. So it really is looking at those 5 factors. And so the beauty and, when the score came into existence, or actually when Mr. Isaac and Mr. Fair first started looking at this, it was about how do you democratize credit? Because historically in the US, I would get a loan if I was friendly with the banker in my town. And if the banker didn't know you or had something against women, the banker had the right to just yeah, exactly. And so what this FICO score did was make it less of an arbitrary decision, less of a subjective decision, and make it, a very black and white decision. And also it isn't one moment in time. Your behavior, both good and bad, can push that score up and down. I won't speak for the group. I made a bunch of stupid mistakes as a kid at college, right out of college, and have recovered from that as a result of finally maturing and managing my finances the way an adult should. And that's the beauty of the score, in that the bad stuff is less negative for you as it gets further in the rearview mirror. So any mistakes that you make, the further in your past they are, the less they impact the score today.
The process of, I guess, challenging some of the report itself.
Right.
Is it automated now? It's still person revisit? Because even images in that world, maybe you have to have some type of, it's not like a regular
Yeah.
something, or, there's going to be something involved.
Yeah.
How is that scaled?
That's the big, and that's a challenge for the Bureau, since they own that data and manage that data. But that's where a lot of people have a lot of heartburn right now, is that it can be very difficult to get something corrected that's wrong or incorrect in your credit history that's negatively impacting your score. So the bureaus are really under a lot of pressure now to figure out a better way to automate that process, correct those mistakes quickly, since it could be inhibiting from someone being able to do something that they want to do. So it's a challenge for them.